This system did not collapse because it was reckless, immoral, or uniquely incompetent. It collapsed because it was engineered to function only under conditions of uninterrupted confidence. When that confidence fractured, the system had no internal mechanism to slow itself down. Before we talk about Lehman Brothers as a bank, or as the symbolic trigger of the 2008 financial crisis, we need to understand what it actually was at a structural level. Lehman Brothers was not primarily a financial institution. It was a confidence conversion system. Its core function was to transform belief into leverage, and leverage into returns. Like all large investment banks, it did not primarily manage money. It managed expectations. Lehman Brothers began in the 19th century as a small commodities trading firm. Over time, it evolved alongside the expansion of modern capital markets. As industrialization accelerated, Lehman became a conduit between capital and growth. It financed railroads, utilities, and large corporations. Each step embedded the firm deeper into the financial infrastructure of the United States. By the early 21st century, Lehman was no longer simply a competitor in financial markets. It was a structural node. It connected borrowers, investors, regulators, rating agencies, and counterparties into a single operational network. Its failure would not remain contained because the system itself relied on its continued operation. Modern finance operates on a specific assumption. Tomorrow will look sufficiently like today. Banks borrow short-term and invest long-term. They assume markets will remain liquid, collateral will remain valuable, and counterparties will remain solvent. As long as these assumptions hold, leverage appears efficient. It magnifies returns and rewards risk-taking. Leverage, however, also magnifies fragility. Small changes in confidence produce large systemic effects. When confidence weakens, funding becomes expensive or unavailable. The same structure that accelerates growth accelerates collapse. Lehman Brothers optimized aggressively for return on equity. This was not unusual. The system rewarded it. Regulators tolerated it. Rating agencies validated it. Investors demanded it. High leverage was treated not as a warning sign, but as evidence of efficiency. Confidence reinforced itself. Risk management models further entrenched this behavior. These models were built on historical data drawn from decades of relative stability. They assumed low correlation between asset classes. They assumed housing prices would not decline nationally. They assumed liquidity would persist, even during stress. These assumptions were not irrational. They were extrapolations of the past. As Lehman expanded, its business model shifted away from advisory services toward balance sheet-intensive activities. Mortgage-backed securities, collateralized debt obligations, and real estate exposure grew rapidly. These instruments appeared diversified and mathematically sound. In reality, they shared a single dependency: confidence in housing markets and credit liquidity. This dependency created systemic fragility. Lehman's balance sheet became large, opaque, and tightly coupled to short-term funding. Repurchase agreements and overnight lending were not auxiliary tools. They were the foundation of daily survival. Any interruption threatened solvency. Financial systems rarely collapse slowly. They collapse suddenly. When housing prices began to fall, uncertainty spread faster than losses. Markets can tolerate losses. They cannot tolerate disagreement about valuation. Once price discovery failed, liquidity vanished. Counterparties reacted rationally. Lenders demanded more collateral. Haircuts increased. Funding lines were reduced or withdrawn. Each action was logical in isolation. Collectively, they produced a self-reinforcing feedback loop. Reduced confidence increased funding pressure. Funding pressure increased the probability of failure. Lehman attempted to respond. It sought new capital. It explored asset sales. It negotiated with potential buyers. It appealed to regulators. But confidence systems do not respond well to delay. Actions that might have stabilized the system months earlier were now insufficient. Potential acquirers feared inheriting opaque risks. Regulators hesitated amid political resistance to further bailouts. Markets interpreted hesitation as confirmation of weakness. Confidence continued to erode. In September 2008, Lehman Brothers filed for bankruptcy. The immediate cause was insolvency. The deeper cause was structural dependence on uninterrupted trust. Lehman had no independent stabilizing mechanism. It could not slow down. It could not deleverage quickly. It could not function without belief. The collapse triggered systemic consequences. Money market funds froze. Interbank lending collapsed. Credit markets seized. Institutions with no direct exposure to Lehman were affected because the confidence architecture of the system had been damaged. Lehman Brothers was not uniquely greedy. Its strategies mirrored those of its peers. What distinguished Lehman was timing. It became the first major institution allowed to fail in a system that assumed implicit state support. That decision shattered a foundational assumption. If Lehman could fail, any institution could. The aftermath reshaped global finance. Governments and central banks intervened on an unprecedented scale. Capital requirements increased. Stress tests were introduced. Central banks expanded their role as lenders of last resort. These measures stabilized the system, but they did not eliminate its core dependency on confidence. Modern finance remains optimized for efficiency rather than resilience. Leverage, liquidity, and belief still define its structure. The instruments have changed. Oversight has increased, but the underlying logic persists. Lehman Brothers illustrates a central lesson of this series. Systems optimized for stability under normal conditions often lack resilience under abnormal stress. Rational behavior inside a fragile structure can produce catastrophic outcomes. This lesson extends beyond finance. Supply chains, platforms, institutions, and states all rely on assumptions of continuity. When those assumptions fail, systems optimized for speed struggle to adapt. Lehman Brothers did not collapse because it was irrational. It collapsed because it was rational within a system that could not tolerate doubt. And that is why it remains one of the clearest case studies of systemic failure in the modern world.